But let's get a little bit of a deeper dive into this report with an expert who's been watching the data throughout this pandemic recovery. And that is, of course, Beth Ann Bovino over at S&P Global Ratings, chief U.S. economist. Beth Ann, it's great to have you on the program this morning. Simple question here. Do you feel like this really high print that we got this month is going to be the top, or should we expect to see perhaps double digits in the coming months?
I see this as near top. My concern is that some of the Russian, we did see the impact on commodities, both you mentioned gasoline and some other things. A lot of that was driven by the Russia-Ukraine crises, but some of the components that some of the commodities that Russia exports to the U.S., which either are blocked or sanctioned, also feed into other prices. You mentioned cars. Cars also rely on palladium from Russia, neon from Russia. That stuff is not going to be coming through anytime soon. That to me says the supply chain disruptions that we're feeling in cars and other production areas are going to still be felt, meaning that path to come down is going to take a long time.
So Beth Ann, don't want to make too much of just 1 month here, but it sounds like your forecast stays here, even if some investors today are reading this number as a peak.
I would say it's near or at the peak, but look, we're at 40-year high. Could it be 43 next month? Possibly so. It's still going to hurt whether it's 43 years or 40 years, and that's the issue. How will consumers respond? Will they start to close their pocketbooks? Will they start to save more? Concerned that they won't have anything left of their dwindling nest egg? Those are concerns that we see, and of course, this is going to keep the Fed very busy as well.
So I guess when we take a look at future reports, what's going to be the focus? The expectation appears to be that, the commodities related bump that we saw in March might not be as high as in the April reports. When you look at things like, for example, shelter, owner's equivalent rent, we're showing that right now up 0.4%. These are increases that are likely to be stickier because of the nature of being locked into a lease or a mortgage. How important are those factors for those future reports?
I think those. So when we talk about the Russia-Ukraine crisis, you can see now that that has exacerbated all pricing pressures. But your point is well taken. That it's not just an international story; it's a domestic story as well. When you look at housing, the home prices have been reached extreme highs. You talked about shelter; that also was extreme, based on people coming back to cities after the COVID-19 crises. So that means upward pressure, another squeeze on household rents. And when you talk about wages, yes, wages are at record highs, but when you factor in prices that have climbed even higher, in real terms, wages are negative, and we don't see that changing anytime soon. That's going to be a squeeze for the households going forward.
There's always this question of demand destruction. At what point do you reach that threshold where consumers say, we're no longer going to buy X, Y, and Z? We're talking about food and oil as primary drivers of these price increases. What are you seeing in food specifically? I'm looking at the number here, up 11% from the previous month.
When we look at the CPI readings, one thing that I take into account, you mentioned core prices, which are core, I guess, is at 6.5 year over year, well above the 2% target for the Fed. The CPI doesn't take into account the substitution effect, meaning don't buy steak, buy chicken, which is relatively cheaper instead. So that means there's a little bit of upside on that. But even if you factor that in, even if you take into account the substitution effect, bringing it down a little bit, that is still 3 times the Fed's target. In terms of households, what we could expect to see, the one positive side, they are sitting on a lot of savings, and that's not just on the high end; it's also on the lower income spectrum as well, giving people cushion. But we know paying these high prices at the checkout stand mean that that cushion will start to wear down, and that's where I see consumers starting to slow. I think they're going to start to move basically into starting to trade down for other things, but then you could start to see them slow down and start to shut their pocketbooks as well. That's probably a story for a few months out, though.
How about the goods to services story? Because there was that argument that, as people maybe stop staying at home, buying things online, as they go out into the economy, they'll spread their expenses and kind of go into categories that haven't seen price increases. But this report showing that services prices increasing at 5.1%, that's the biggest pace fastest pace since 1991. Is that a concerning narrative for you?
Well, I guess the good news is it's a lot lower than what was for used car sales, which I think was over 30% year over year. But what that means is that the upside. Think about it. the food, the food that goes into those restaurants, it goes into the menus that restaurant makes, has also gone up. Restaurants are pushing that forward. What you could expect to see, and we did think we were going to see a kind of an adjustment in the consumption basket, meaning that everybody was at home, bought up one home or second home or even a third home, had to fill it with lots of stuff. That does reach a saturation at some point. You would expect to see people moving away from goods purchases to services as people got out some more. So we would expect to see that. And of course, what you also signaled is that inflation is everywhere, not just in goods, and certainly not international. That's just going to be another squeeze. I think people will still be going out. Again, they do have some cushion, but I think they'll be just more circumspect about where they spend it.
Yeah, thinking a little more about what the plans are on the horizon here. Beth Ann Bovino, chief U.S. economist at S&P Global Ratings. Good to have you on today.